Decoding RBI's circular on risk weights, impact on NBFCs banks, and alternative sources of future funding to NBFCs. Moderator Mr. Ashish Agrawal, Director, Resurgent India Limited. Eminent speakers Mr. Kishore Lodha, Chief Financial Officer, Ugro Capital. Mr. Sunil Kumar Yadav, DGM Retail Assets, Union Bank of India. Mr. Kasim Saf, Senior Manager, Vinod Kothari Consultants. Mr. Sanjay Shamnami, Head Treasury Co-lending, C. Creva Capital Services Private Limited, Kisht. Mr. Parag Srivastava, Head Financial Institutions Government Banking Group, Ujjivan Small Finance Bank Limited.
Good evening, friends. I am Ashish Agrawal from Resurgent India, and I'm very happy, glad to be a part of this panel discussion on the very important and very hot topic in the current scenario in the banking and the NBFC industry, which is related to this latest RBI circular on the risk weight on the consumer credit, actually. So from the wholesale credit point of view also, consumer credit point of view also. And friends, I would like to welcome all of you in this panel discussion on the virtual meet on this topic. And we have very, very good panel speakers. Those are veteran in their field, and we have banks, this PSU bank and the small finance bank. We have large NBFC grow, then we have the fintech NBFC also KIST, and then we have a leading advisory firm on the NBFC or banking side is to Vinod Kothari and consultant. So friends, it's a very, very diverse or very, I think, experienced panel which is with us. And we are basically, we'll try to cover up the aspects of the whatever the RBI has covered in the circular. And then we will discuss on the impact of that on the NBFCs and banks, and what will be the impact on the consumer also. And along with that, we'll discuss the diversification of the funding sources of NBFCs or the fintech companies, because this is also important to discuss the circular, what will be the future of funding. So that will also be covered. And I would like to thank you to all the panel also. They have committed or they have joined us with one very short notice in this webinar. And the audience also, attendees also, those are joining us from different part of the country, from the different background also. So I believe that once we'll finish this session, you will be having more understanding or more knowledge about this topic. And I will request all of you, please ask the questions, whatever the questions are in your mind, you can write in the chat box, where we will try to cover up in this session, or will not be in a position to cover up in this session, then we'll cover up, we'll send you through mail the reply of these questions through mail also. So, so that we can make it more interactive. And you see, we are reading the newspaper on a daily basis. We are getting news, different news on this topic. So we have prepared a small PPT which will help you to know that basically what are the guidelines from RBI point of view, and what is the impact on the banking also, on the NBFC also, from the leading industry players point of view. So I'd like to again welcome to all of you in this webinar, and I hope that I'll justify in my role as moderator whenever the session will get finished, you'll be more knowledgeable. So there is a small PPT which I'll just run it here. So I'll request to my team to please run this PPT. So Rohan, can you just... So friends, this is basically related to this RBI circular which has come on 16th of November. So almost 20 days before, where RBI has covered 3-4 areas where the one area which is related to the consumer credit exposure of NBFC. and then the consumer credit exposure of banks, and the consumer bank exposure to NBFC, and the credit card exposure. So we see in this slide, uh, uh, so we see in the slide this consumer credit exposure of NBFCs. There is a risk weight increase from 125 to 125, where the housing finance and the education loans, gold loans, and MFI loans are excluded from that. Actually, we will discuss in detail what is covered, what is not covered. So majorly the RBI increase and the consumer credit by banks, commercial banks to the consumer directly. Again, the risk weight has increased from 100 to 125 crore. And they have excluded these items, which is housing loan, vehicle loan, and gold jewelry loans also. So on these both the cases, the risk weight has increased from 100 to 125. And when the banks have given the credit to the NBFCs, then there also this risk weight has been increased from 100 to 125. And we'll discuss in detail how much it will impact on the uh, differently rated NBFCs. Then the credit card from banks and NBFCs, where the risk weight has increased again from 25% in both the cases. Next slide. So I would like to just, before taking the discussion on this next slide, I like just to say that what is the risk weight actually. Many people will not be aware of what risk weight actually. So there is a provision in the lending system where which are governed by the RBI. There is a requirement of capital allocation on the lending basically. So there is a different risk weight requirement from the RBI point of view. When you are there, suppose any bank is lending 100 rupees to a borrower, then they have to keep certain percentage of capital reserve for that actually. So this is basically risk weight. So and for NBFC, it is different. For bank, it is different actually. On that, the RBI has increased from 100 to 125%, 125 to 150% actually. And if you see, the RBI has tried to flag off 2-3 times about the unsecured lending or consumer credit, which is happening in the country. Then finally, they have come out with the circular in 16th November. So they have flagged off in April and October 2023. And still there was a growth in the portfolio earlier. And just to curtail or just to basically regulate in such a manner where the risk weight will increase, the RBI has come out with the circular. And we see the data, then the personal loan exposure of the banks, the overall loan book is something around 48 trillion actually. So 48 lakh crore is the total exposure, which has increased from 27 lakh crore actually. So there was a huge growth in last 1 year. More than 20-25% growth came into the last year in this portfolio. That's why I think the alarming situation, or that why the thought behind the RBI that there should be some checks on that. So that's why they come with the circular. And if you see the large banks like HDFC, ICICI, Kotak Mahindra, their unsecured book has grown like anything, which is more, they have more than 30% portfolio which is into the unsecured lending actually. Next. So this is something what is covered, what is not covered. So priority sector loans, which are basically we call PSL loans, which are not covered into that circular. There will not be any impact on these loans actually. The MSME loans are also the most of the MSME loans are in the priority sector, rather it's covered in priority sector only, so there will not be any impact. The one thing very important to note here that LAP loans for with no restriction, or the LAP loans to the personal category, personal loan category. So this is a area where many of the players are not very much clear that whether it will be covered in the priority or non-priority. But what we understand, it will not be covered into priority, and there will be increase in the risk weight on that actually. So many people are thinking that the secured loan will not be covered into the this thing risk weight increase. But what we understand, we'll discuss in detail also. But the LAP loans for business purpose or business purpose loan, secured business purpose loan will not be covered. That's circular. and the loans for commercial vehicle are excluded from the this, and the finance purchase finance transaction, the supply chain financing is also not come. And this BNPL and fintech loans, why now pay letter loans actually, typically what we call this BNPL, they are covered into that circular. So any BNPL loan will also be covered into that circular from the risk weight point of view. Next slide. So this is again, I think from the risk weight point of view, so in this slide, the most important part is loans to NBFC by banks. So if we see from the risk weight point of view, so there are basically credit rating where the NBFCs are taking from the different credit rating agencies. So we see the AAA, AA, and rated NBFCs. Those have taken the loans from the banks. They will be impacted in this circular, from this circular. And in terms of percentage, although it is 25%, but in overall, in the absolute term, we will see the AAA rated companies will have will be more impacted from the capital provisioning point of view, and AA and A will have the less impact, and triple B rated companies will not be impacted because they have already have the 100% risk weight on that actually. So this is our view, but we'll discuss in detail with the panel. Next. So this is basically the unsecured retail loan of the total bank borrowing is something around 10%. So as of today, I think we have more than 160 lakh crores of the bank borrowing, overall borrowing. Out of that, 10% is 16 lakh crore. The personal unsecured personal loan or retail loans are there. And in NBFC space, it is something around 12 to 14%. Banking, it is some 10%. And the last point is very important. Actually, if you see, although the GNPA, this segment overall, GNPA is not much. It is something around 1.4% as per the published data, March 2023. But the worry is that the SMA account actually. So SMA is something around 7.4%, which in the SCB is actually the commercial bank, which is, I think, the area which need to be discussed. And I think this is because of this, the RBI come out with the circular. Next. So if you see the chart, this unsecured retail credit of the bank. So in 2018, it was something around 3.25% of the total banking funding, which has increased to 10% actually. So it has multifold in last 4-5 years. And if we see from NBFC point of view, it has also grown. And the bank funding to NBFC, there is a good growth also in the overall bank funding from banks to NBFCs. So currently it is something around 14 lakh crore actually. So it has also grown very fast. And if you see the different banks point of view, so overall, we see the large bank in the country, secured loan exposure in case of SBI, it is very, very high in the overall book. And then the other banks also, the HDFC Bank is also having very high exposure. This is based on the published data. So the large banks have the larger exposure in terms of percentage also, in terms of the overall portfolio also, because their book is large. So their portfolio is also large on that actually. Next slide. So this is related to bank and NBFC credit growth in last 1 year. We see the overall credit growth from 2022, September 2022-23, although it is less, from the banking credit point of view, but in the personal loan category, the overall credit growth is not has not grown, but personal loan credit growth has grown from 22 to 30%. And this in the NBFC case also, the NBFC growth is also multifold in the unsecured loan category. So this is, I think, area which need to be discussed here. But what is the estimate now? Basically, this growth will not be more than 14%, 15% in the end of this year, actually, which was something around 25% in the last year. Next. Next slide. So if we see from the NBFC point of view, their exposure in the unsecured loan. So there are large NBFCs like Chola, Bajaj, or Aditya Birla or Indostar. They have, rather the Indostar, Aditya Birla, Bajaj, and SBI credit card, because SBI credit is 100% basically personal loan, but these large companies have the exposure from the 15% to 45% actually, which is, I think, very important to discuss here, what will be the impact of the large companies. Next. So if we see the from the vulnerability point of view, the category wise, so fintechs are having the major portfolio on the personal loan side. So 67%. This is a care report, care rating data where they have published that 67% on the fintech side. And then the other segments, the private sector banks and the public sector banks, it is within the range actually, so to 10 to 12%. So I think the major impact will come on the in case of any delinquency will increase or all, it will impact on the fintech side. Next. Next slide. So this is related to the overall impact on the banks, on the NBFCs and banks in case of this the new guidelines or new exposure norms or new risk weight basically. So we see the Bajaj Finance will get I think impacted more. So there will be increase in the capital requirement from 240 basis point actually, which is on the very higher side actually. But all other banks and NBFCs, the range is less than 100 basis point actually. Next. Although SBI has large exposure, but the overall impact is not much. So what we think that from our point of view, what will the impact of this circular? So there'll be more, I think, transactions on the co-lending or DA side, where the NBFCs will be more interested to go for the co-lending partnerships with the bank, or maybe partnerships between NBFC to NBFC also. Then there can be the higher borrowing cost to them also, because the banks will factor this capital allocation or increase in the risk weight, which might impact their borrowing cost also. And on the diversification point of view, the NBFC may look for the other sources of funding also, either NCD, ECB, and the CPs also. There may be other alternative instruments which may part of not depending on the reliance on the bank only, but they will look for other this thing. And then there will be I think increase in the borrowing lending cost to the unsecured consumer loan actually. So in turn the consumer will end up paying the higher cost of borrowing actually. So there might be increase in the ultimate ROI to the consumer. So overall the consumer will be impacted. But we think there will be impact of 10 to 15 basis point on the overall cost of the NBFC, depend on the rating category of the NBFC, in which category they fall. And there'll be more capital will be required by both NBFCs and banks. So we just some of the areas where we think this will be the impact on the overall NBFCs or banks also. Next. Next slide. So we see from the fintech point of view, as I told in the earlier slide, that the fintech lenders may be hit the hardest, like companies like Paytm, Cred, and Navi, FinServ. Yes, some of the names, or there may be other names. There can be other names also. So there can be the options for them. They can go for the priority sector loans. They can look for the loans which can be more focused on the education loans or loans against property, or they may consider of unsecured loans to MSME or micro SME enterprises with Uddam certificates. So this is from our understanding point of view. Definitely, we have the panel which will basically give us the right direction or right understanding also. So, friend, this is something which we try to cover up, keeping in mind the different media articles on the RBI circular also. Hope it will be beneficial to you to understand or to get the idea basically what is the circular and how it will impact on the overall banking and NBFC space, and the overall the consumer also who is raising or who is taking loans from the system actually. So now I will come to the panel, and we have very diverse panel. So I like to invite Kishore Lodaji. Kishore Lodaji, the CFO of Ugro Capital, and he's all-rounder actually, a champion of the fundraising and the NBFC space. So Kishore, first of all, welcome to you.
Thank you so
And
much.
Kishore, we would like to understand from you basically from the circular point of view, and the overall discussions are going on. What are your views on that? And will there any impact on the Ugro also on that because of this circular? So
So,
over to you, sir.
yeah, thank you so much, Atish ji. Thank you for the nice words. You have covered almost everything very nicely in your presentation. So I don't think that there is too much left for us to say or elaborate. But I would like to discuss it in three parts. One is on the asset side, how the asset side will get impacted, how the impact will be on the capital, and of course on the liability side, which is the borrowing side of banks and NBFC. So on asset side, as Ashish ji mentioned earlier, that housing finance companies, gold loan companies, vehicle finance, and microfinance has been kept out of it. So so it is applicable first. First, all of us should understand that it is only applicable on consumer loans. So non-consumer loans are completely out of purview of this circular of November 16. Most of the people believe that it is applicable on unsecured loan, but it is not applicable on unsecured loan. It is applicable on unsecured consumer loans. So when we discuss housing, gold loan, vehicle loan, and microfinance loans, which are kept out of it, then almost 85 to 90% of the total AUM of NBFC industry or overall industry is outside the purview of this circular. So on the asset side, the impact would be very, very limited on very few entities, as Ashish ji mentioned, who are very heavy on either on credit card or on consumer loans. Some of the names which were mentioned. So there is a very limited impact on the some of the fintechs. So in terms of AUM, the impact would be very less when the risk weight is increasing. And also, I believe that there is sufficient capital in the system to absorb the increased risk weight on the consumer loan as well. So the system overall, banking as well, and NBFC at this point of time is sufficiently capitalized. So there, I don't see that immediately there would be any impact on any of these entities as well. Of course, going forward, when the risk weight of some of these entities would go up, their ROEs may get impacted. ROA would remain almost similar, but since the greater allocation of capital would be required, ROE would get impacted. As far as Ugro is concerned, we are completely into MSME lending, and we don't do a single loan which is not Udyam-backed loan. So every customer has to be mandatorily Udyam registered. So we don't have any exposure towards consumer loans in any capacity. So our asset risk weight asset would not increase by even a single rupee. So there would be a 0% impact on our capital. On the liability side, I believe that since banks are almost 40% lenders towards the NBFC space, there the risk weights of, as Ashish ji mentioned, that increase from 20 to 45, 30 to 55, and 50 to 75. Part of these loans are priority sector, part of it is non-priority sector. Where there is priority sector lending, then there would be no impact. Where there is non-priority lending towards NBFC from banks, so we may see some amount of hardening of interest rates. But since it only 40% borrowings are from banks, so as Ashish ji explained, that I also believe that the impact on the system on borrowing cost would be limited. So we will discuss it in detail. I would let it other panelists to air their views before I come back again. Thank you.
Thank you, Kishorji. Thank you. So you rightly said, actually 90% assets are out of the purview of the circular, actually, in the NBFC space. So that's a very big statement which you have given, a great statement also, and it gives a lot of confidence to all of us, actually. And then another statement which you have given, there is sufficient capitalization there, already there. So the NBFC are already capitalized in a well manner, actually. So that's good, actually. And so thank you very much for your views. Now I would like to invite senior banker with us, Sri Sunil Kumar Sri Yadavji. Sunilji is in charge of the retail assets in the Union Bank of India. So Sunilji, first of all, welcome to you. And as a banker, we would like to understand from you what will be the impact, or what are your views on that, actually, on the circular from the banking point of view, and will there be any impact on the Union Bank also from this circular on the overall capital requirement, or will you are you thinking to basically increase the cost of NBFCs also when you are lending to them? Sunilji, over to you. You are on mute, sir. Sunilji, you are on mute.
So thank you, Ashish ji.
Thank you, sir.
For inviting in this today's program, which is a really very eye-opener, I think, sort of program, and panelists are also to the sync for this topic, I think. So this November 16th circular, really all NBFCs, all bankers, they all have worked on this, and I think already analyzed in our bank also. We have actually the unsecured loan and minus the exclusions what RBI has said. So the portfolio is hardly out of our total this retail segment. It is less than almost 10% of our total retail asset. So we have already analyzed our exposure personal loan segment, which is to be affected or being affected by this circular. So including credit card segment. So there is nothing to be worried, but since capital cost is required for going ahead, so I think we are all very calculative, and this time just for our bank, I think at present we are going very conservatively. I think around 10%. Our growth is around 10% in this segment, and expected our March target set is 15%. But for this segment, and we have although as a entire retail asset, we have set an aspirational target of around 20 plus percent. But I think in recent 2-3 months, I think we are not seeing much growth in retail segment. Last year we had launched this digital personal loan. So I think that last year we had a very good growth due to that. But now our this time just for some period we are not this lending through digital. This is now we have stopped for certain this RBI's guidelines are also. So I think for this towards NBFC financing, we are financing NBFCs, and selected NBFCs we are also going for this co-lending and pool buyout. So I think all our endeavors are going on at par, and for the adequate risk measures we have taken. But just in initial, so only we have discussed our just I think maybe to wait and watch type of thing is also in our bank, and we are just a sort of go slow, or our type of this policy we are adopting at present. But maybe in coming days, some we will open up for other things, looking to the scenario of other banks also. So this is the thing, sir.
Okay, thank you, Sunil. Thank you very much. So you have given that message that you may be having the wait and watch policy.
Yes.
For the time being, basically. But
Yeah,
overall
for the time.
growth, overall portfolio, yes, sir.
Yes, sir.
So overall retail portfolio is not much of your bank, including credit
Yes.
card, which is less than
Yes, sir. Yes.
10%.
That's why it is
So there is
no much impact is there.
nothing to worry, actually, nothing to worry.
Yes, sir.
Okay,
Yes,
very
yes,
good, sir. But the over the lending which you are doing, you'll keep continue. You may have the wait and watch for some time, but
Sure,
not
sure.
be much of the impact. Thank you so much. It's a great
Sure,
message
sure.
you are giving to our audience. So, sir, we have Kashinji from the Vinod Kotharian consultant, and he heads the Bangalore office. So, Kashinji, thank you very much and welcome to you. He is quite young, and I think young people will give us the right direction also now, because our country is also very young actually. So, Kashimji, being a leading consultant into the financial services space, you will be getting a lot of inquiries from these people, and so you like to understand from you your views on that circular, how you are guiding your clients, or how do you think that will there be any impact on the overall funding to NBFC, or there is any red flag or any situation where there might be some challenge in the overall book quality of the NBFCs or banks also?
Okay.
Over to you, Kasimji.
Thank you, Ashish ji, for your kind introduction. So, as we have already heard an NBFC player and a banking player speak out, we are usually placed in the middle of them. So, you have already heard what their views are. I will just build up on what they already mentioned and give us a little bit in more detail. Kishore ji already mentioned that when we talk about where these increased risk weights are applicable, it's not secured or versus unsecured. That's not the question over here. That has been a very big question that we are constantly facing. Secured versus, and to the extent I can say that it actually doesn't make a difference. There can be a secured loan which is given for a personal purpose, would still carry 25% risk. It is the end use of the loan. Where is this particular amount being used? That is the critical aspect. Because we need to understand that these loans pose a specific risk, because these do not end up being additional. These loans are actually to be paid out from the borrower's own pocket. What its existing income sources are, he has to bring out money from that and pay out. So these risks is there, because when you talk about a business loan, usually when a businessman takes a loan, he puts it into the business, and that can result in increased revenue. That's not the case with personal loans. That's the very first point, that the secured and unsecured loans differentiation is not there. It's about the end use, where the end at the end loan will be used. Then we discussed about whether there are any concerns. So as Sunilji mentioned that currently there are no concerns as such. But of course, given that the growth rate these loans are going, the concerns could have arisen. This can be taken as a timely measure by RBI, that on time they got into the picture. They put up a increased risk weight. Of course, Kishore ji also mentioned on this that when we talk about increased risk weight, the end impact on the balance sheets might not be that huge. Majority of the assets are not covered in it. Increase in cost would also be morely because banks have to allocate more capital. There is no increased riskiness of the asset that would prompt them to bring in more risk premium to the loans. But of course, if they have to allot a more capital to it, which banks in India have, I don't think banks in India are struggling for capital. They have capital, but anyway, they would be cautious with their capital. If they are allocating more capital, they would demand an increased price. I think Sunil ji and Parag ji are here to give us more details on that first. So there will be a slight increase, but anyway, this more brings these particular topic to the table of the RMCN board. When these files get to that, that actually the more bigger change that the circular has brought in, that we feel currently is less impact on the balance sheet, but more impact on the perception how these loans are being seen. Before that, personal loans were very good. Everything was going on. Recovery rate was fine. But with this, regulators bringing in a slight warning, increase in risk rate, that gives a slight warning to the players. And that perception towards, as Mr. Sunilji said, he is also reconsidering his position. First he would be into disbursement mode, now he's into wait and consider mode. So that's a change that the circular has brought in. Anyway, India currently financial sector entities are not struggling from a capital adequacy point. Some of the entities might face some issues who are on the borderline. They might face issue in further disbursement, so they might have to rush in to bring in new capital from that side. But for some entities would surely face that, but majority on the side, currently all the financial sector entities seem pretty well capitalized, so not much big of a concern, but it seems like a timely measure. That's
all. Okay, very good, I think. So you have rightly said that any loan which is for personal purpose, whether secured or unsecured, both are covered in that actually. It's a very good clarification, very right clarification also. So we should not think always that only unsecured loans are covered actually. So secured loan for personal purpose will also be covered in this. So thank you so much, Kasim ji. Friends, now we have Sanjay ji, the head of treasury, the co-lending in the company called SI Creva, which is the brand name KISS. Sanjay ji has vast experience in the fintech space. So welcome Sanjay ji, and thank you very much for joining with us. Sanjay ji, we'd like to understand from you, because you are from the fintech industry, and everybody talking about fintech growth and the digital lending by fintech actually. So what are your views on this RBI circular, and how it will impact on your journey in future or in the current situation also? So over to you, Sanjay ji.
Sure. So Ashish ji, first of all, thanks for having me as a panelist along with such a reputed panelist like Kishore ji and Sunil ji and Parag ji. Just to add out what these seniors has already put on the board. They actually said that this is more of this is not going to impact asset, and NBFCs are more capitalized. I just want to lay out the objective of coming by RBI with this. Even if you understand the RBI MPC meeting which happened today, the objective was not to curtail the loan growth. The objective was not at all to stop the loan growth. The objective was more of to put the risk mitigation process in place, where you already have seen a growth of personal loan segment from 38 to 48 trillion dollars, right? So if I have to think about the guidelines which has come across, it is not stunting the you have to be slow down your loan growth. It is more indicated. Should have a stick. You should have a set of principles to underwrite your loans properly. You're not, and the more importantly, which we follow, the case that
your voice is breaking. Sanjay, थोड़ा voice break हो रहा है आपका. You can continue. You can continue, please.
Disbursing a loans where the consumers are stressed out already, or they have a more of.
There's some issue on the connectivity on Sanjay's side.
Ashish, can you hear me now?
Now we can hear you, sir. Please continue.
Yeah. So sorry. Okay. I couldn't understand where you heard me. So let me repeat the overall scheme of things. So Ashish ji, thanks for having me as a panelist, first of all. And I really concur the seniors which has already put on the platform. I would like to just add one point. The objective of this circular is more of not to curtail the loan growth. It was more of to ensure the risk mitigation process are actually while in place properly. If you also understand or you go back and check even today's RBI MPC meeting, where Deputy Governor specifically said out that we are more focused that the players are actually having a preventive measures to ensure the loan growth happens. So even at case which we do follow the mechanisms is that when we are underwriting loan, we do ensure that our consumers are not overburdened. They are not burdened with the three or four more loans already existing in the market. Their debt burden ratio is more controlled within the scheme of things, which should be play out over a scheme of 24 to 36 months for the tenor which we are offering. Also, if any major events happen like COVID, and if there is a subvention of their income from, let's say, 20 to 30%, so that event is also taken care in the factor. One more thing which we also ensure that our loans should not have a cross subvent with our existing fintech partners which who are in the peer. Otherwise, it will happen that they will have a superiority to on the payment options. So that's the control measure which we are following already, and I do see that there will be a big challenge from the fintech as a space which is actually taken control for the market. But I would, and that's the reason I took a step to come on this call to ensure that this is not going to impact only fintech. If it is impacting the overall NBFC sector. There's nothing to do. It's nothing. It's to do with who all are into consumer credit space. That's it. So that I see, and if you, that's all my records on the part. And I see the only challenge which we could see from the borrowing cost. Yes, there will be impact on the borrowing cost. Will be have some basis point uptakes, but it will not have a loan growth challenge at all from this perspective.
So yes, for you, thank you very much. I think you rightly said there will not be any impact on the loan growth, what you are saying. So if you can cover up a little bit on the KIST point of view, will there be any impact on the overall balance sheet or capital requirement?
No. So I don't see any challenge right today, because today if I have to see my capital adequacy ratio, we stand at 48%, considering the current risk-weighted asset is 100. If I have to go back into calculate at the 125, which is a mathematical calculation, still we fall at the 42 as a capital adequacy ratio. So we still have a headroom to grow for another 8 months to 12 months without any equity event. And however, which we are also planning to have it very soon in 6 months down the line. So I don't see any challenge which is going to impact from our operations perspective on respect to the loan building or loan growth, you could say.
Okay, thank you so much. Thank you, Sanjay ji. I think you're rightly given the message. You have very good capital adequacy ratio, so will not be much of the impact on the overall capital requirement and the growth of the business also. Thank you so much.
Sure. Yeah.
So friends, we have another leader from the industry, Mr. Parag Srivastava, the head of financial institutions. So he's the right person who is working day in, day out with the NBFCs and he's working in the bank also. So Paragji, first of all, welcome to you and thank you very much this webinar. Paragji, we would like to understand, because you are a small finance bank actually, and most of the small finance bank are erstwhile NBFCs actually. So you have the experience on both the side actually. So what do you think, being one side you are lending to the NBFC and the another side you are lending to the small borrowers and the consumer credit. So from your point of view, what will be the impact on the overall lending to NBFCs? Will there be an increase of the cost, or will there be slow down in the cost also, slow down in the lending also, or the diversification of funding of the NBFC? So do you suggest them to go for the alternative routes also? So over to you, sir, and thank you very much. Parag.
Thanks, Ashish ji. Thanks for having me on panel. So my previous panelists have already covered a lot of points, but before I come to your specific question, the basic rationale of increasing risk weight one on unsecured loan was obviously because it is being building at very high growth rate. CAGR was very high, and there were some concerns raised on the portfolio quality or of any major risk of that with those NBFCs. But the other part, the lending to NBFCs, it was more driven by the increasing ratio of bank funding in their overall liabilities book, which has gone to around 43%. So basically the message was to kind of reduce or diversify the borrowing sources or the fundraising sources for the NBFCs. So overall, as Sanjay was saying, the objective was not to kind of put a brake on the loan growth, but I have some 4 messages critical which I take from it. One is obviously for NBFCs which are heavily in unsecured lending space, they should have additional capital buffer, because for them impact is twice. One is obviously their own risk weight is increased for their own lending to end customers. And also the banks which lend to them, obviously they also have additional risk weight. So it's a double impact from that point of view. So additional capital buffer would be required for them. There is also a message for maybe if you are too much concentrated on a single product, try to balance the portfolio. Maybe add certain secured product also, which will, we discussed certain of the options earlier. And also there is a message that the appraisal systems, even banks as well as NBFCs need to consistently improve and also have a very strong surveillance and monitoring mechanism to monitor it. Because ultimately, if you have those risk mitigants developed, then obviously the growth can be calibrated and growth can be good. And also NBFCs need to diversify. As far as Ujjivan is concerned, we were earlier MFI, then later become a bank. So larger, if you see our priority sector book, even on retail side, is very high. It's more than 80%. So largely our own capital impact on our lending to end customer is not very high. It will be to the extent which we lend to NBFCs, and very small portion of personal loan or certain loans which are end use is for the personal purposes. So the capital impact on us is not very large to that extent. But overall, I feel that there might be some moderation in the unsecured lending over the year in the near term, and there might be certain pricing impact which will be there on lending to NBFCs.
Okay, great. So I think we have covered all the panel speakers in the first round, and the views are very, very, I think, positive. That on the from the organization point of view, there is not much impact on the capital requirement, and there will not be any challenge in the further lending also. Maybe little bit slow for time being. Maybe wait and watch policy will be there, but they will continue lending to the same segment where they are lending actually. So that's a very good message to all of us. But the cost may increase. So on the other side of this discussions which we have, so initially we could understand the views of the panel, but there's certain specific questions are there which I'd like to ask from the panel, which maybe there's some hardcore questions also. So Mr. Loda, I think Swarji, because you are very well involved into the fundraising and you have you are dealing with various institutions. So what do you suggest for the NBFC sector or NBFCs in terms of the alternative funding sources? Because of the regulatory guidelines and overall, because RBI has come earlier also that this 25% exposure should be from the debt capital market and all. So being UGRO has the first comer in the co-lending space, or maybe you are doing some green funding and all these various new aspects which you have already brought in the system. So it will be helpful to the other industry players if you can cover up the alternative funding sources for the NBFCs. So they should also try the sources to diversify their liability side. Over to you, sir.
So thank you, Ashish. So what the way I look at this circular of increasing risk weight on NBFC is is not in isolation. I see it as a continuation. So from 2017-18, we have seen a series of events which are prompting regulators and the overall ecosystem to create various kind of regulatory and other challenges for especially for NBFC in terms of liability management. So we have seen that after 2018, some major defaults happened and people were extremely cautious in lending to NBFCs at that point of time. Then COVID happened. Then this circular comes, which directly or indirectly suggests that the bank should be a little cautious in lending to NBFCs. So NBFCs by this time, some of the large and small, medium, all segments of NBFC had learned to live with it. But because there are alternate avenues which are being opened up regulatory and otherwise. So one of the major avenue which has been opened up by the regulator itself is co-lending, which is a very, very hard task. I always say that doing a co-lending is not easy. It is not everybody's cup of tea, both from banker side as well as NBFC side. It is a very hard task to get your policies integrated with a bank, then getting the people alignment, getting the technological alignment, and then getting every case-by-case approval from a bank is not an easy task. But once you start the process and once you go through the journey, then your life has become a little simpler. So we are fortunately one of the first movers in co-lending space in India when it was announced, the regulation announced, and today 45% of our AUM is being catered by co-lending. That means that much capital we don't require, that much borrowing we don't require on our balance sheet, and we can easily scale it up. So it is a hard task, but it is a very good resource. Banks are very keen to do it. Regulators are very happy that banks are doing it because One is that the underlying risk is direct customer, not an NBFC whom the regulator may have some views. So this is a very good avenue where this is still a wide space. The overall business volume here is only roughly around last year it was closer to 25,000 crore, where the direct assignment securitization itself was more than 2 lakh crore. So which is a one good avenue for all the NBFCs. Of course, it is a very hard journey, not an easy journey, but it is a good avenue which has been opened up by regulators. Second is now since still we are still talking about whether India is developed or developing. So in official terms, we are still developing country. Though some of late I have heard from some of the large global impact funds that whether you categorize in developing country or developed country, but officially we are still developing country. And our level of governance, our level of awareness in our system, whether it is bank, NBFC, fintech, whatever you call, is pretty high. At this moment, and the global players, global lenders are far more comfortable dealing with Indian entities now compared to even 5 years back. The KYC compliance, the governance framework, the underlying operational framework, etc., gender parity, green. So all these aspects which are their primary focus area, there we have done a lot of work as a system in India. So a lot of fundings are overseas lenders are keen to lend. Of course, the challenge is that since inflation in some of the larger European and US countries are very high, which has they increase their benchmark rates significantly high. So it is no longer cheaper per se. It is now significantly expensive compared to an Indian borrowing. But again, it is a source. And of course, today the rates may be high, but usually Europe and US, the inflations were always very steady. So we can hope that the situation will come back again to normalcy, and then we will see a lot of funding. Third is that once banks would be little cautious in taking very large exposure on NBFC, but at the same time, everybody will have to look at their AUM, asset quality, etc. NBFC are, I still believe, the best borrowers for banks because their default rate by segment wise is the least. So banks will continue, though their risk weight capital allocation may increase, but bank will continue to focus on NBFC as a segment of their customer, because the credit risk profile is very different from any other segment bank lend, whether it is MSME lending, whether it is credit card lending, whether it is a gems and jewelry segment, whether it is any kind of industrial segment, any kind of infrastructure segment. NBFC is the best segment by far for bankers. So they will continue to focus. But at the same time, when they will have some slightly higher capital requirement, they will focus on taking assets from NBFCs in the form of either direct assignment or PTC. So I think it will further propel banks and banks to look at more of DAs and PTCs to look at. And of course, on capital market side, now there is an alternative venue which is getting created. Of course, there are regulatory challenges around where a lot of distribution channels have been opened up in terms of platforms who are taking private placement of NCDs from various lenders and whoever needs money, and then they are using their distribution channel to. So that is again a significant option. Of course, from DHFL ILF is happening in 2018. Of course, smaller and mid-sized NBFCs getting money from large institutions like mutual funds is a difficult task, and I believe that it will continue to remain so in foreseeable future. So these are 4 or 5 avenues which are available, and I don't think that the growth rate which are being there we have seen in NBFC space, for the want of liquidity, that growth is going to get compromised. I don't see that.
Very good, sir. Thank you very much. I think you're giving very important statement that NBFC assets are far better than the other assets in the banking book actually. So that's a very, very good statement, great statement. And then we have suggested our diversification of sources. So overseas funding can be one of the area. Then maybe the debt capital market and the PTC and the DA or co-lending can be another area. So you suggest that the NBFC should try to diversify their liability side. Maybe there may be a little bit higher cost today, but overall cost will not be much actually, or will not be average. Overall cost will not be impacted much, but they'll not be dependent on the banking only, and they'll not be in any situation where such kind of circular is coming or maybe slowdown is there, then they'll be in a position to lend as per their business plan. Actually. Thank you so much. I think it's a very good statement which you have given, sir. Now we have Sunilji. Sunilji, so if you see, because banks are regulating by RBI, and whenever such kind of changes are there, I've seen that more reporting, more compliances are involved. Actually, if you see, so what announcements are being made in your bank compliance and reporting framework to meet the demand of RBI circular? So, do you think that more compliances are required, or are you doing something like that?
No, sir. Actually, on day-to-day basis, also we are being regulated on day-to-day basis. RBI SSM is always present in our office. So I think there is, and particularly for this circular, just as we already discussed, it is only our risk team is they have already taken stock of the position, and whatever extra capital is required, they have already given the plan to the management, and there is no, I think, much worry on that side. And as such, just to give the insight for review of the exposures under personal loan, this way, that way. So we have given so many data and other things. So that primary works our bank has already completed, and I think in coming days bank will come out of this policy guidelines, and I think in product also there will not be much tweeting. Only likelihood, the most likely is this some pricing effect will be there, as earlier speakers also said, for NBFC also and for bankers also, there may be in this segment, there may be a bit hike in the pricing. So otherwise, not much, I think, things are there.
So you got, Sunil, thank you very much for your views, but I just want to add one more discussion there. So from the underwriting point of view of the retail borrower, actually, when you are doing personal loans and all, will there be stringent norm? Because with this circular, I think something has been already been flagged off. So will there, are you changing in your underwriting process, assessment process of these borrowers? Or?
So actually, since last few years, I think 4 or 5 years back, we have already towards centralization of all our credit underwritings, and particularly for retail as such, in Toto, we have centralized the process. So at field level, there is a retail loan points in our banking structure, and at head office level, beyond the proposals, beyond the delegation of that field, that comes to our office, and luckily I am also heading that committee. One centralized retail lending cell is in our head office. So both mortgage based and non-mortgage based, and I am heading the non-mortgage based this committee. So everything is structured. Our system is very smooth. I think all the things, whatever in a good credit underwriting is required, looking to the civil score or the parties' due diligence, everything we are taking, and everything is in place. And time to time, we are taking review of our policy also. Recently, also we have given to the good experts or consultants, you can say, like IIM Bangalore and MDI Gurgaon, we have hired for this purpose to study our review our credit underwriting system prevalent in our bank, and compare with the industry leaders. So I think on that also we are very our policies, and we are at keeping everything in mind, and our top management is very serious about all these things. So I think our underwritings are adequately structured. I think no worry.
Okay, great, sir. So you have rightly said that you have centralized system, or you are making it centralized. So in your case, all the loans, retail loans, are also sanctioned through centralized process. Actually.
Yes, sir. Yes, sir.
There are no delegation at the field, actually.
Field level, at branch level, there is no delegation. At branch level, there is no delegation. Only for exceptional looking to the season and competition, only up to small vehicle loans we have given delegation to the banks, and small education loans like up to 7.5 lakhs to some wherever this mortgages are not required, and other than that everything is centralized. So every loan, all the personal loans or this retail loans rather we can say is centralized, and through
Okay.
centralized almost 85% of our books are through centralized system. 15% just since it is just a second year of centralization, so just 15% still branches are doing, and 85% we are handling at centralized centers.
Very good. Very good. And second point, which you have told that you are engaging the management firms, management consultancy firms for the betterment of the underwriting process.
Betterment and yes, sir.
So this is a big change. I think, I believe the banks are also concerned that how they can do better and better actually in the processes and systems, so that the better quality of assets can be created, and the overall asset quality should be good also. Thank you so much. I think you have given a lot of insights, and it will be helpful to our audience. Many people are there from the different banks also, so they might think of these measures also to be taken their systems also. Thank you once again. Kasimji, you are already talking to many NBFCs and this thing. So what strategic advice would you like to offer to banks and NBFCs to effectively navigate the changes introduced by the RBI circular? So any advice which you want to give to the industry to navigate the change, whatever the changes are brought in the system?
For me, it would be a difficult job to give a strategic advice to, a giant sitting over here. But to our analysis, what we have been learning while working with several financial institutions, that one thing that was very commonly came into the very moment the circular came was that we need to raise more capital. NBFCs might need to raise more capital. But currently, the scene does not seem like that. For some of the NBFCs we did encounter, for some of the we were working with, they had to rush to markets to get in funds. Equity was, of course, not a source at that very urgency. We looked at alternate sources like subordinated fundings, subordinated debt, TDIs, to get in a capital adequacy as a stable level so that our disbursements has to not stop. So the very first thing that here needs to consider is increasing capital is a difficult job. And if you want to calibrate on your capital properly, we are seeing an alternative very good in the form of a securitization transaction. Because when we talk about DA or a co-lending transaction, the risk weights continues on both lender as well as on the originator's books at 125 only. Because for banks also, for a consumer credit, it's now 125%. But when we talk about a securitization transaction, if a bank is investing into a PTC, the risk weights there have not been changed. They are still based on the table of the ratings that are there. So if you have a AAA rated security, PTC would carry what a risk weight of 20-25%. So that is a huge difference between what capital you need to maintain on a investment in a PTC as compared to a DA pool that you have purchased. So similar pool, if you have purchased on a DA, your risk weight will be 125. But if you invest a PTC backed by that same pool, given that there is a credit enhancement provided by the...
Sir, please be on mute, sir. Thank you, sir.
Sorry.
And please carry on.
Yeah, please carry on.
So that's the one point. And second, and not only from the investor, from the banks or the larger NBFCs, from the larger NBFCs, that is of course there. From the originator side also, initially what was there was that if you talk from origin, if you securitize the pool, that pool gets removed from your risk-weighted assets, irrespective of the accounting derecognition. Your accounts would get removed from your risk-weighted assets. But yeah, what would happen is that the originators would be providing a credit support. So you need to provide capital against those credit supports. So usually any credit support of 15% or more, because you are maintaining 100% risk weight, any credit support of 15% or more, you would not have any capital benefit from the originator. Investor, it's always there. It will be always there from the originator side. But now that limit for a consumer protection loan, consumer loan would shift from 15 to 18.7 because the risk weight has shifted to 125. So if you have a securitizing a pool and your credit enhancement level is at 15%, you still have a 3.75% benefit for security. So from a strategic point of view, now securitization can offer a much more capital release than it was previously, given the change in the risk weights. That can be one avenue that can be explored by the industry player.
Very good point. I think you have rightly said that you want to conserve the capital. The securitization can be one of the route which can help you to conserve the capital also, whether the risk weight or the capital requirement will be less actually. And this is a huge gap also. So that's great. I think it's a good suggestion which we are giving to the industry. So Sanjay ji, and I'll come back to you. So Sanjay ji, being a fintech, currently most of the fintechs are basically on the digital lending, on the consumer side, consumer lending, and also, do you think there will be any mix of credit offering will be offered by the fintech companies in the near future? Or other than that, what is your basically this advice, or what do you think that the access of credit by both the new and existing customers, will there be any impact on that, which are in the lower income bracket actually? So today I was seeing, I think some of the financial institutions have announced up to 50,000 crore, 50,000 rupees loans. They are now basically stopping or slowing down actually. So will there be any impact on this? Yeah, please cover on that. Thank you.
So I just take one by one. So on coming to the first point where you are specifically mentioning the mix of credit offerings by the fintechs. So if I have to see the future of the fintechs, they have two options. Either they go into consolidations or they have to go for IPO. And if you have to go for IPO, you won't find any NBFC player in market which has an unsecured portfolio. So if you are in the edge of, or your entity is like that, you are well mindset and well focused, that you have to not to go for consolidation and has to go for the IPO route. So they have actually opted, or they have actually strategized their AUM growth, which is mix of secured and unsecured. Coming to the point where we stand today, in respect to the same, we have started consumer lending way back in 2015, and we have seen the growth of our AUM customer base from till today 1.8 crore customer base. And what we have seen that 1.8 crore customer base which we are catering, the 20% of the customer base which has a similar customer base into the LAP product program, 18% of customer base which is in a similar auto loan program, and 12% of the customer base is similar in the gold loan program. So this is what we started analyzing 15 months back, and we have started planning this financial year to go live with the LAP product also. And the last 6 months, we are doing secured LAP for strategizing on the product finalization, tech integrations, and branch optimization, where we can do fulfillment of the MOU to be created or the registration to be created. So yes, I do agree there will be a mix of trade offerings, but these are those fintechs where they have a good well capitalization in their place. They have a good asset quality in current with respect to the industry norms. They are profit making. They are like us. We are generating the good huge profits on monthly basis. So these three factors, if allows you won't go for the consolidation. You go for the IPO route, and you will start planning your assets mix accordingly, unsecured plus secured in some sort of way. And one of the reasons we started doing so, because in the consumer space where we are operating since last 5 years, we have seen that our customer base is mix of 55 to 45, 55 tends to self-employed. And these self-employed are nothing but those which are actually one notch above the micro loans and one notch below the marquee LAP loans, which are done by the highly banks. So these are those LAP loans which is operate between 10 to 20 lakhs of ticket size. So one of the reasons which we excite us to do this, and this is what we started evaluating from last 6 months, and we are go through with this process in this financial year. We'll have some reflection of this product in the AUM composites. Now coming to the second part, which is actually more of the 50,000 ticket size in this. If you see this 50,000 ticket is of consumer product which we or other player are offering. This forms 0.5% of overall today outstanding portfolio of the market. So since the percentage of overall is very limited, so it will not impact. But the reason done so far, which has been complaced, it's because in this small ticket size loans, what happens that you actually are not able to do operation successfully. You should have a well capitalization on the operation place. You should have a well dedicated a calling team, collection calling team, and FOS team. Normally in the lower ticket size, your unit economics doesn't allow up to justify these ticket size loans, right? So, but if you have a good unit economics in place, which justify how to manage the operation fees, then I won't see any challenge. But yes, coming from the lower income buckets, yeah, they will face some heat in the market from this consumer space or the other unsecured loan which is offered by the good market players like of the other Fullerton and kind of big names which is also operating in the market in the PL segment. So yeah, they will see the pressure. But overall, this is my thoughts on the credit offerings and the easy of the new and existing customers.
Said Sanjay ji, and you've given rightly that there may be cross-selling of the existing customer for the mixed product basically, which the other fintech company may also think of, which you have already started last 6 months before or maybe before that. And you have a lot of database, lot of customers basically. So that's one thing. And another, you have rightly told, there may be heat on the lower income group. Not because of that it's not viable, because the overall volume of the value is very less, but the unit economics is one of the area because the lower ticket size loans basically the overall operating cost is very high on these actually. So this may be the reason for that it may impact actually. Right.
Sure. Yes.
Thank you very much for your views on that actually. So that's good. Actually, the industry will change a little bit from the unsecured or consumer loan. There will be mix of the other loans also. Thank you so much. So Paragji, I'd like to come to you on this the second round basically, and we'd like to understand from you that is your bank considering adjustment to interest rate on existing exposures and future lending to in response of the RBI circular to NBFCs, because you are heading this department. And if so, what factors are influencing these decisions? If you can cover on that, although it's a very hard question, but we'll be happy to know from you.
Yeah, before the just Ashish ji, I will one thing I would like to say that each bank, whether it's a large commercial bank, private bank, everyone has a NBFC exposures, and depending on each bank's risk appetite, that may be 5% to 15% of overall loan book. And the reason why banks see this credit as a very good credit is, one is obviously they have inbuilt strength. They also do the same kind of lending what these NBFCs do, and the understanding of risk assessment is very good. And the second, obviously, the point is that as one of the panelists has said that the credit, if you see the credit losses has been very, very low in this segment. And so the banks will continue have focus on this segment, maybe the sectoral caps, etc. They may say how much they have to do or which unsecured they might have some subsector. On a specific question on interest rate, obviously the pricing metrics for every bank for the NBFC has a cost of capital component to it, which has increased. And it is not increased for the new loan, it is increased for the previous loans as well. So as far as new loans are concerned, I definitely believe that there will be some passage of that cost to the new loans. Now, if you have to break even, considering the exact risk weight increase, it might be higher. It might be 60 bips to 100 bips. But in my view, that might not be, there might be partial increase. So it may be ranging from 15 bips to 60 bips, depending on the ultimate rating. That's what I feel in the new loans. As far as old loans are concerned, again, banks have right to increase because it's a regulatory change. But the only thing is it will be depending on, the trend will be clearer in another 1 or 2 months. And obviously that if there is a revision in an existing loan, that would be led largely by the larger banks, and other banks may follow the trend. It will not be initiated by some smaller private sector bank or SFB. It will be largely driven by PSU or large private sector bank, and others may follow. But there is a rationale, because even for existing loans, the cost of capital has gone up. And obviously the ROEs to that impact from the loans when it was originated has come down. And NIMs also for the lending bank has come down. So to cover to some extent, there is a justification for increase that. But that will be largely depending on how the larger banks react to it, PSUs and private sector bank.
Okay. So very well said, Paragji. And You rightly told that on the new loans, there might be much impact in terms of pricing, maybe 15 bips to 60 bips. But existing loan, it's depend on many factors, the cost of capital of every institution and the appetite also, and the relationship with the, I think this will be driven with the relations, because what I have interacted in last 15 days with many NBFCs, large NBFCs and banks also. Although this will be arm twisting between both of them, because the banks will try to increase some rates, but NBFC will take some lot of plea, and they'll have a lot of reasons for not to increase the existing borrowing cost. But there'll be, I think, there'll be some increase, which will depend on organization to organization. So existing loans will not be impact much. That's why if you see, I have given in my presentation that there will be impact of 10 to 15% overall. The people are saying there will be, the market is saying 25 to 50 basis point, but overall impact at the end of the day will not be this much large actually. And the new loans, definitely there will be much impact. So that,
Ashish, just to add one very important point, because there is one silver lining in this both for NBFC and banks, because within the cap of the overall NBFC sector, if you see, the concentration of larger bank has been towards high rated entities, because the differential of risk weight was very, very large. So ROE's impact on high rated lending was much, much higher. Now that has kind of narrowed a lot because of higher risk weight for high rated entities. So that is, banks may slightly diversify more into triple B good rated entities who are triple B, and some part of credit will go to triple B also, because that will help banks to balance their ROEs, and also the lending part, what it is going today to that segment, it will be higher portion will go. So that I would say is a kind of the narrowing of this ROEs because of this high risk weight would be a slight positive for triple B rated good entities.
That's a very good message, because triple B entity will also get some money or good money from the banking system. Other banks will start thinking on that also. That's good. But as you told, the larger entity, larger banks are having the larger exposure of the high related entities. But again, you have seen earlier also, the larger entities or larger NBFCs are always having the bargaining power actually. This is a real fact actually. When you go for the reality on the paper, whatever we are discussing, that's okay. They will have the lot of reasons not to increase the rate of interest on the existing borrowing actually. But definitely there will be some impact. So that's good actually. So friends, I think we have already crossed the time limit. I think we will have time to till 5 o'clock, but we have reached to 5:20 also. So I would like to, I think, wind up this session here only, and I would like to thank you to all the panel. There are some questions also which I'm seeing on the screen. The one question is there from somebody: why the credit score of the personal loan borrower is totally ignored in unsecured consumer loan? Should not a portfolio of unsecured consumer loan with a high proportion of borrowers with a high credit score should attract lesser RW, I think, return risk weight? So, would anybody like to cover on this question? Basically, the question is related to the scoring of the secured loans, and the high risk weight loans would get the higher rate of interest, and low risk weight would have lesser rate of interest. I think this is the question.
So I will take this. So actually, what question theoretically has been put in is correct. That even a customer is having 600 CIBIL score and 700, are at the same risk weight as far as the asset size is concerned. But actually, nobody prices a 600 CIBIL score customer and a 750 or 800 CIBIL score customer similarly. So that risk-based pricing is part of the nature of lending industry, despite the overall risk weight of that asset. So same segment of customer, different segment of the customer would be definitely getting priced according to their credit worthiness. So that part is being taken care always by the system, not just because the risk weight remains same for their capital allocation. So these are two separate things.
I agree with you, Lodaji. I think from the consumer credit point of view, Sanjay ji can highlight on that, because his question is, I think, in case of consumer credit, personal loans, the credit score is not the more important thing which people are seeing actually. So is it right, Sanjay ji, or what do you suggest?
Just here to intervene, Ashish ji. Actually, this in consumer loan also, we are pricing based on the score of the customer. And I think, as you told, that's a different slab, 750 and above, 700 to 600, this 750, 650 to 700. In all these segments, our rate of interest are varying. So I think this is for rate of interest, means pricing to the customer. For capital and other thing, what question is RWA. RWA, we are not taking care. Just our pricing is like that. It has an effect of factoring all these things. So we are charging from customer. So differential rate of interest we are taking based on their score.
So just to add, Ashish ji, what the question is here. So yes, it's very clear that whatever loans we do as a consumer space, we do rely on the bureau scores. 95% of our portfolio across the fintech which I've seen is the 650 and above CIBIL score. However, there's a 5% of portfolio which is new to credit, but that is more dependent on the alternate data which we use to underwrite the customers. Now coming to the part, the benefit which we have seen in the consumer space to pass in on the benefit to customers who are actually 700 of upwards or 750 of upwards. It's more of from the ticket size, it's more from the additional score bands which we come across. It's more get set it off the in compensation of some basis point. But since overall portfolio, like Kishore said, it's remained the same. It's like from preview of the RBI or its preview from the lender, even though we approach, it's treated as unsecured, so they fall in the risk weighted of 125. But however, yes, there is a benefit given to, if you are 700 plus CIBIL score, you will get a more tenor of the loan, you will get the more ticket size of the loan, and accordingly, you will get some concession in form of the interest rate or other charges which we do levy. So there is always a benefit given to it, considering this as an approach. And also there is always benefit given to the customers. And yes, we do rely on the bureau. That's the core of even unsecured space.
Okay. Thank you so much. I think because there was some understanding that in case of personal loan, there is no differentiation in the pricing if the score is 650 or 750. So you have clarified. There will be some advantage, but there will not be much of the advantage actually. Because most of the product-driven approach are there in this segment actually. So, but
yes,
we understand.
Yes.
Right, sir. So thank you so much, sir. Thank you to all the panel speaker, Kishore ji, Sanjay ji, Sunil ji, Kashim ji, and Parag ji, for your nice deliberation and lot of insights you have given. And I believe whatever we have discussed, it will be beneficial to all our participants, and this will overall the message which we got from the panelists, that the unsecured consumer loan basically only 10% of the overall system. So it's not like that there'll be any very large assets are there in the overall credit system. So there'll be any impact on that. It will not be much in the overall credit this thing. And the another message which is there, that the sufficient capitalization is there in the all banks also, and the all NBFCs. So this whatever the risk weight increase on both the side, whether on the NBFC or banks, it will not impact on their capital requirement, or they'll not be below the threshold limit of the RBI, because they are far ahead of the RBI threshold of the capital requirement. So this is another, there's no stress on the capital side because of the circular. And there may be an impact on the ROE. So ROE definitely, return on equity, may be impacted in the short run, or there may be a little bit slowdown on the short run. One panel, somebody has told that they are on the wait and watch. So there might be some wait on this. On the diversification of funding sources, our panel has suggested they may be a little bit slow on the banking side, but the NBFC should focus on the diversification of the funding sources. So either the ECBs, they might be a little bit costly, but the overall average cost will not affect much, and they can diversify on the PTC because of maybe capital conservation point of view, and maybe getting the diversification on the liability side also, or the debt capital market also. That's the another suggestion which has come. And our panelists have suggested the existing lending for NBFC, they'll not be there may be some impact, but not will be much impact on the overall cost. But the new lending definitely will be impacted to some extent, which might have been absorbed by the industry also. For the small loans, which we are seeing 50,000 and less. So overall, the ratio is 0.5%, the overall unsecured lending. Also, the volume may be large, but value-wise, it is very, very less. So for the timing, this may be impacted because of unit economic cost and all these. But in the longer run, there might be some the technology which may help to reduce the overall operating cost, and all. So these loans will continue the same manner. So it's a very good message which we got from the all panel, and the deliberation is also very, very healthy, where the objective was just to decode the RBI circular and understand the diversification of funding sources of NBFCs and the impact on the banks and NBFCs also. So I think we have achieved the whatever we were trying to we understand, and our panel giving very good views also, and the audience has also asked some questions also, and which have been replied very well by our panel. I would like to thank you once again to all the panel speakers, and I would like to thank you to the Resurgent India team who had worked hard on this webinar, basically on the virtual session. They have invited all of you, and they worked on the PPT and all. So the Rohan and the Ans and the other team members, they were involved into that. And I would like to thank you all the attendees also who have come from the different part of the country, of the different industry, or different segment. And I would like to thank you once again for joining with us. And I hope that this will be helpful to all of you. Thank you very much. Thank you all. Thank you, sir.
Thank you. Thank you.
Thanks.
Thank you,
Thanks,
sir. Thank
Ashish.
you.
Thanks, everyone.
Thank you. Thank you, sir.
Thank you, sir.
So I hope it is
Thank you, everybody. Thank you.
done by the IT from back office. That should be the